All right. So good afternoon or good morning, depending on where you are, or good night if you're coming from another part of the world. Thank you so much for joining us today. My name is Laura Cohen. I am a sales director at Complif, and I am going to be your host for this conversation on navigating national AML priorities. As we all know, this are the AML priorities that we currently have that have been announced, but there are supposed to come new ones. But there's not a clear regulatory implementation guidance. That part is still pending. That has created a lot of uncertainty across the industry. Many financial institutions are asking or wondering how much should they be changing now. How should risk assessments and KYC processes reflect these new priorities? And how do they prepare without overcommitting, disrupting operations, or creating friction for customers? That is what brought us here to cover the national priorities. This is a quick overview. Here we have 8 national priorities, which is corruption, cybercrime, including relevant cybersecurity and virtual currency considerations, terrorist financing, international and domestic terrorism, fraud, transnational criminal organization activity, drug trafficking organization activity, human trafficking and human smuggling, and proliferation of financing. So before we want to get started, we want to definitely have a quick disclaimer. So the views and opinions expressed during this webinar are solely those of the speakers and do not represent the official positions of their respective organizations. And to help answer these questions, we're joined by 2 industry experts who have seen this landscape from both sides, from enforcing the law and building AML programs inside financial institutions. Not only are they experts in their field and expert speakers, but also wonderful human beings who are really in the fight to do the right thing and be very ethical in this space. First, I would like to introduce Raymond Villanueva. Raymond is a former special agent in charge of the U.S. Department of Homeland Security, now director at Kaufman Rossin. Raymond spent decades leading global enforcement operations across 73 countries, managing 600 plus agents, and briefing U.S. Congress on money laundering, cyber threats, and transactional crime. Raymond, thank you so much for being here with us and joining us. We also have David Gerhardt, who is the BP and BSA officer at Atlantic Community Bankers Bank. David has built and scaled AML programs through periods of rapid growth, fine-tuned alert systems to meet regulatory expectations, and held BSA integrations during high-stakes mergers and acquisitions, all while maintaining strong relationships with the regulators. So, guys, the goal for today is not to provide you a checklist, but to have more of a practical, forward-looking discussion, right? We want to make use of these 2 amazing speakers and really have discussions that are going to help the compliance officers, those risk managers, and executives think through how to really stay agile in an environment of such uncertainty. So with that being said, let's go ahead and jump in. To start off, we know that there's the lack of clear guidance so far. How our institutions are going to be approaching risk assessments and KYC programs. Should they be taking immediate action, or is it reasonable to wait for more concrete direction? So I'm going to go ahead and stop sharing my screen. So to start off with, first question that we want to cover, right? So we've had conversations before. You both touched on the lack of clear guidance. That leads naturally to the question of how are institutions, how are they going to be reflecting the national priorities in their risk assessments and their KYC programs without overcommitting resources too early, right? Should they be documenting consideration or actively already changing methodologies? Ray, you want to give it a start first, and then we'll have David chime in?
Yeah, absolutely, Laura. Thank you so much. And thank you for that nice introduction, framing the national priorities, where they're coming from, where they're going to. I mean, you touch on some very unique points that are really important. And every time we talk about the so-called national priorities, we really want to reinforce that notion of we do have the national priorities by statute, but we do not have implementation guidance. And while the proactive person in me, based on my background and experience, want to say, yes, I'm going to take this into consideration, the reality is that I don't have a set of instructions from my regulatory body to say, hey, Ray, you're going to do A, B, C, and D, right? I mean, whether is detailed or at a more notional level, we don't have that. So I would say, I mean, my opinion would be that while we can use the national priorities to inform our processes and approach because they offer a lot of great information, changing processes, policies, procedures might be a little bit premature because we're going to change it to what? To then get a set of implementation guidance and have to change that again. So I would steer clear from big changes again to policies, processes, procedures internally to accommodate or to bring national priorities into my process, whether it's the risk assessment, whether it's the onboarding. But I would certainly use that information as a hint. The government, for the very first time in US legal history, is telling financial institutions these are the things that are important to me. I would totally use that to inform my processes, and I'll stop here for now.
Yeah, I echo a lot of what Ray is saying here, and I think the big thing is we've been kind of sitting in a spinning cycle for the last 18 months, or I don't even know how long it's been at this point, but it's kind of like a planning for whenever this day comes. But we've had an administration change down in DC, of course, that not getting political, but how does the new administration shape everything that was codified under a prior administration? But I feel like we've been in kind of a spinning cycle at this point where it's been a lot of planning, a lot of education nonstop. I mean, that's the big thing that we've been doing is a lot of education that here are the national priorities. But it's that there's no action at this point on our end. We're waiting to really see what happens. But I think the other piece of the national priorities is just anyone that's an experienced professional in this space, there's nothing really new in it. It's all what we've been doing. It's just kind of reshaping what we've been doing into priorities now and pulling some of these out as more important than others than what they were. But there's been no real action. It's just been kind of continuous planning. And I think the biggest piece is that it's the planning, and I keep mentioning that P word, but planning. And if these do get pushed the whole way through, you should be ready to jump type of thing, but you don't have to jump at this point. It's more of how can I position things so that I'm in a better position when these get through to act? But there's been no acting at this point.
Thank you so much. So, touching on another part of it, and just to get a little bit more specific on the priority itself, and we can kind of assume that we're kind of updating risk assessments or mentally preparing for this, or in general when talking about updating risk assessments, right? Usually comes down to which threats to prioritize, right? I will say and this is like a two-part question. So, of the higher risk areas, let's say correspondent banking, fintech, and virtual currencies, which are you seeing that as most of scrutinized right now? That's the first part. And how should institutions approach the more complex risk like terrorist financing, proliferation financing, and transnational crime, where typologies aren't always very clear on that side?
I'll take a shot at that, Laura. So, so typologies and red flags are no longer clear for anything because nowadays we have this figure called professional money launderers, the enablers. And as the economy, the legitimate economy, I should say, globalized, criminal enterprises are globalizing as well. So my problem now is not to launder $150,000 because I was selling narcotics in the corner of Walk and Don't Walk. My problem now is how can I launder multi-millions of dollars that are cash within an economy that inherently doesn't use cash because we are a plastic economy. Talking about us in the US, right? I don't remember when was the last time that I had $20 in my pocket because it's so convenient to go and pay with my card. And while I'm paying with my card, I have a record of my purchase, but I also get points. I like points, right? So it becomes a challenge. So where are these areas? What are the areas that should be important? I would start saying, part of me wants to think everything is important, but everything cannot be a priority because if everything is a priority, then what is a priority? So every time we are delegating a task, notice that I said delegating a task because we do not delegate responsibility. That risk responsibility belongs to our financial institution. But every time I delegate a task through either correspondent banking, banking as a service, third party relationships, every time I do that, to me, that is a high risk function because I can no longer control everything because I delegated. So, correspondent banking, for those folks out there providing banking as a service to fintechs, every time we get into working with aggregators on the payment world, every time we have those type of third party relationships, we need to look those through a very, very nice scope, and really need to amplify our understanding of the threat and the overall risk for the priorities. Now, you asked about particular priorities, and I would say this: what I'm expecting, and this is me, the former government SES, the former government executive, what I'm expecting is that because David hit it right in the head, there's absolutely nothing new about this. This is something financial institutions have been doing forever. Everything is risk-based, and in order to assess a risk-based approach, we actually look at priorities, or let's call it what they are. They're crimes. They're illegal actions. So, what I'm trying to say here is that what I think, and this is my opinion, again, we don't know what we don't know. And last time I tried to use my crystal ball, it failed. But I'm going to give it a shot now. What I think is going to happen is that FinCEN might come back to say, hey, Ray, for you to say that you do not bank A or B, or you're not within a region that is known for human trafficking, or you're not within a region that is known for nuclear energy, you cannot say that human smuggling, terrorist financing, or proliferation finance apply to you. I think what's going to happen is we're going to have to exercise our due diligence, run through a test, through a process to show that we're mitigating that risk or the risk is not applicable to us with evidence, with concrete evidence, as opposed to, no, that doesn't apply to me. And folks might be thinking, oh, Ray, that never happened. I cannot tell you how many times I have worked with esteemed clients that, for example, I'm born, raised in Puerto Rico. And I remember working with somebody within that jurisdiction that said, hey, Ray, we don't have a human trafficking problem in Puerto Rico. And I go like, what? So that's not going to cut it. Just to say it's not applicable to me. There are no nuclear plants in Puerto Rico. We don't manufacture weapons in Puerto Rico. Therefore, proliferation financing is not going to be applicable to us. That's not going to cut it anymore. That's what I think this merging priorities into a risk assessment might come in, where we're going to be now, I don't want to use the word forced, but we're going to be expected to conduct a process that either mitigate or identify risk within each and every one of the priorities.
Yeah, so really good points there, and a couple things I'll comment on and add. First, I think the risk assessment key is data, and your data is going to lend you to be able to concretely prove why or why not something is a risk. I think that that's an important one. I think also going back to the risk assessment, I think we've been expecting guidance for how long on what is actually required in a risk assessment as well, and actually making the requirement to complete a risk assessment. So that'll be something else that'll kind of shape on how all this goes. But, I think almost every bank completes a risk assessment, because if you don't, then the examiner completes it for you, which I don't think you want to have happen. I think you want to be able to get in front of that one and tell your story on where the risk lie within your institution. So I think, going to the virtual currency one, I think that's a big one at the moment. And that's, part of a shift in DC that we've seen with the virtual currency, the Genius Act coming out, and everything else. And I think that that's really constantly evolving at this point, that the appetite with this current administration is a lot higher than what the prior administration was, staying out of the political space on this. But there's obviously been a lot more attention on it. I'm hearing a lot more in exam space that examiners are starting to ask a lot more questions surrounding virtual currency, digital assets, crypto, stablecoin, the whole host of it. So I think it's going to be very interesting, and I think you're gonna have to be able to tell your story on why it is a risk or isn't a risk, which falls into a lot of these other ones. We've talked on it on why it's not a risk, why it is a risk. You need to be able to tell the story, and that's going to come back to the data piece of it. If you can prove, I have had no ACH transactions to Coinbase, BitLocker, any of these other places, that's a better story than we don't transact with virtual currency. You got to be able to take that next step and prove why or why not it is or isn't a risk. And so I think the big piece and the overarching on this with my point of view is it's back to the data. And as Ray said, and we touched on, these are all things that are priorities in their own nature. It's just one, they're all priorities, period. Some are going to be bigger priorities based on your geographic location. I mean, the targeted geographic order for CTRs didn't really affect us being in the Northeast, but I certainly took it to the board and made sure that they were aware, because you never know where the concentrations are going to be, or when the next geographic targeting order is going to affect something with Canada, and then it becomes a big risk to our Northeast banks. So keeping the board educated is a huge piece, which I think plays right into the next topic that Laura is going to go over here.
We'll touch up on that topic more towards the end, but we're going to touch on a very good topic as well, which it's it's an issue not just in this case, but anything or any changes that are made in financial institutions, which basically goes down to, yeah, these risks are complex, but institutions still need to serve clients efficiently, right? So how do you balance deeper KYC and AML checks with the need to keep customer experience smooth and transactions moving quickly? So that's a big piece when there's any type of change, right? And what happens when the risk assessments identify gaps, but then your business partners push back against any operational changes? So how do you navigate that? Keeping your customers happy, making sure that the changes are not too dramatic, especially on the onboarding side, on the KYC side, while at the same time expect, the risk assessment comes back and you need to make changes, whether it's, technology or however they come. How do you navigate that?
Maybe you want to take a stab at it first?
I'll take a stab at it first and flip the order up for once, and I'll try not to jump ahead again here. But I think first and foremost, it's an education piece that we have to know. It's a twofold education and communication, that you have to educate the salespeople and everything else that are trying to get and obtain new customers, new clients. This is the target client. And just as importantly, this is not the target client, and why. Like if you don't want to bank a certain client, and it could be because of the risk, it could be because of a geographic location aspect, a whole bunch of different items on why you don't want to bank someone. The communication to the sales team is critical, because you want to nix that before it gets down the road. I mean, if you're not going to bank Ray just because he's Ray, you want to stop that at the beginning before you go through, the onboarding paperwork, the due diligence, the signature cards, setting everything up, and then it gets the back office review a week later. Ray's already has his account for a week. what kind of experience is that? Ray's obviously going to tell his friends, family, etc., not to come bank with you because of that, versus you still leave some respect in the air if you kind of cut it at the beginning. I can't bank Ray based on X, Y, and Z. Obviously, this isn't a dig at Ray on any aspect, but just as an example. And I think you communicate not just saying no, but why you're saying no. So someone that's had to do that a lot, if you get in front of it and you get the disclaimer, the why, et cetera, in front of it, the sales team's going to understand a lot more for future items, and that's going to help kind of eliminate the repetitive going back and forth on items, and it's going to be efficiencies too. And you obviously, if you're in the BSA officer seat, your salary gets paid by the salespeople and bringing the business in. So you have to be as flexible as possible within the identified risk appetite of your organization to keep that money flowing, but also allowing you to adequately manage the risks. So it's kind of a delicate dance and where the scale has to turn. And most BSA officers, myself included, the scale probably tips towards no a lot more when your examination friends are coming in versus the other time of the year, you might be a little bit more apt to say yes on items. And so I think some of it too is your regulatory burden. Where are you at in your examination cycle? But not only that, but what is the examination focus at the moment? And we had the marijuana binge probably 3-4 years ago. That seems to be coming back a little bit more. But I think it's crypto and everything else at the moment real hot and heavy in your fintechs and everything else that we've touched on. So I think it's really the communication piece is the huge one to make sure that the sales teams know what's expected, what they need to collect, and the consequences if they don't collect it. And do it all. I like to say touch the piece of paper once versus going through the piece of paper 6 and 7 times to get an account open. Because you've turned a typical, if you touch it 6 and 7 times, how much longer does it take for a typical individual DDA to become profitable versus if you only have to touch it once, the barrier to profit's a lot quicker. So I'll pause there and Ray, let you jump in with your fantastic stories and experience.
So, David, I mean, you hit it right in the head. I mean, communication, communication, communication. It's to me, sometimes it takes me back a little bit when you start talking throughout an enterprise, and an enterprise, I'm talking about a financial institution, and there are key players within that enterprise that do not quite understand the risk assessment. They don't understand the what, the how, and above all, the why. And David hit it right in the head. We need to communicate across the enterprise. When the regulators come, there's no bank 1, 2, 3 compliance, bank 1, 2, 3 business, bank 1, 2, 3 this, and bank 1, 2, 3 board of directors. There's bank 1, 2, 3, period. We are one team, one fight. So communication is key to make sure that we are aligning processes. If we don't communicate effectively and our business people do not quite understand what is the risk appetite, but also why is that risk appetite, they could be going out there as part of the business objective seeking extremely high risk that is not beyond risk appetite. Risk appetite is a word that is important to us, but that's not the issue. The issue here is that it's beyond our capabilities, whether it's people, knowledge, or tools. And now that's a problem. Now I'm taking a risk I don't understand, or I don't have, even though I understand the risk, I don't have the tools to address that. I mean, David mentioned the crypto, the cyber world. I want to get into cyber, and I'm going to start banking crypto, and I'm going to be serving as an on and off ramps and all of that. And then David is my regulator. David comes to me, hey Ray, what are you using for blockchain analytics? And I go, blockchain what? Wait, you want to go to crypto? You're going to be serving as an on and off ramps, crypto to fiat, fiat to crypto. So you're going to be aggressively going into the market. How are you going to analyze those transactions? What's your visibility? Because you don't even understand what the blockchain is all about, right? I mean, so we need to make sure that we understand that. Onboarding. Part of what I do and my background is, as you can see in the back, is law enforcement, is conducting investigations all over the world. So we think about financial investigations, and sometimes we think what generates an investigation is an alert, but the reality is your investigation starts at onboarding. An analogy I use, onboarding is like Christmas. It's like the holiday season. When the holidays were coming, I was telling my kids, you have to be great. You need to get good grades. You need to be good with mom. You need to do your chores. You need to clean your room. And everything is great until the day after the holidays. And then they go back not to be good, not to get good grades, to be rude with mom and dad. Our clients or prospects are more prone to provide good data, good information at onboarding when the risk to your institution, and David alluded to that, is zero because they're not clients. That account is not open, they're not transacting. So you have a really good opportunity to leverage onboarding, to leverage technology at onboarding, to gain knowledge from priorities and other processes, to request all of your data. Because if you build a phenomenal data warehouse and quality data, your investigation will become easier. But if, as David mentioned, if we wait to have Ray running already for a week, Ray is already a customer, but KYC onboarding wasn't properly done. Now my customer experience is just going to go down drastically. And I'm posing a risk to your institution. Above all, this is the key here, that you don't quite understand because we don't have all the elements that we should be collecting during that onboarding process, dotting the I's, crossing the T's.
Yeah, just to jump in a couple additional comments that Ray tripped in my memory here, but first and foremost, the onboarding is key. The KYC piece is key, but you need to verify it. Good data is king, but verify what the customer's telling you too. I mean, you're not going to come into the bank and say you want to open an account to send money to Al Qaeda. You're going to do that after the fact, and that's going to not match with your account opening KYC. So that's pretty big to the expected versus actual activity and marrying that up. At some point, actual activity will trump expected. The debate in the industry is at 3 months, 6 months, 2 years, et cetera. But you always have that expected activity to go back and compare, contrast, and leverage for what is expected for the customer relationship. The other piece, expanding on the risk appetite, you have the risk that you want to accept, and then the risk avoidance is another thing. Fraud, for example, I can absolutely 100% prevent all fraud from occurring at the institution, but it's going to take forever to do a single transaction, and then that's not going to make you any money. If we wanted to prevent wire fraud, think about the process to go through. You're going to have callback procedures on the originator. You're going to request documentation on the wire. You're probably going to reach out to the beneficiary bank. You're going to get some type of communication there. All in short, it's probably going to be a week or more until you actually release the wire. And if you go through that, who's going to actually send a wire with you versus going to another bank that's just going to process the wire? So that's where you have to put in your mitigating controls that can still make some type of risk-based decision to get the wire through in some type of fashion that's fairly quick, but that it's going to give you a reasonable belief that you're going to prevent most of the fraud. Again, risk-based prevention of fraud versus 100% risk avoidance of fraud occurring.
That was great, guys. Thank you so much for that. And that leads me into perfectly into the next question. So, obviously, of course, any tightening of onboarding or due diligence has to be explained internally, right? Whether you're, needing resources, technology, training, whatever it is. How should compliance leaders communicate? So back to that communication that Raymond mentioned. How do you guys communicate evolving priorities to your boards, to your senior management, to your partners, especially when you're not ready in terms of budget as well? Maybe smaller institutions as well, when budgets are tight and guidance is still vague. So there's no need, to give money when there's no, it's so vague and we don't know what's going to happen. And what approaches have you seen that work or been doing yourself that will be able to get you more into alignment across the organization as well as with your partners?
So I'll take a first stab at that, and then Ray, you can jump in as well. But I think a real good example is kind of how a lot of banks are approaching the Genius Act that just went through. What we're seeing is a lot of banks are at the education stage on the board, that you're educating your board on what is going on. Side note, if you haven't started the education with the board, you're late. That this is something you don't need the board to make a decision at this point on a lot of this stuff, but the board can't make a decision unless they understand it. And so this is a really good illustration on how to go about when new items are passed. Educate the board on what they're going to have to make a decision on. Educate senior management. They can't make a decision adequately that they don't understand the nuances with. And they need time to process the information, ask their questions, and better understand it. So I think that gets us back to, the onboarding and due diligence. Your board sets the tone. Your board drives where your risk appetite is, drives the level that's accepted to come through the door. And ultimately, you need to staff in your BSA department, your AML, your fin crime department to manage that risk. And if the board wants a super low risk appetite, it's going to be a different level of staffing requirements, management in the BSA space than if it's a super high level. And you just have to make sure the board understands the repercussions for their decisions on where they're setting that bar. And I think the evolving priorities piece, that's going to be really determinant on what the final rules look like on the national priorities. If we have to do one thing, it's going to be a whole different level of staffing. And I think this is a very good example of kind of where we've gone with our board, is that we keep educating. And based on the education, they're going to be able to make a quicker decision on what is needed and what this bank's stance is going to be for the national priorities. And I think that that's really where you want to be at this point, going back to the national priorities, is that your board knows where you are and knows kind of a direction that you want to go, but we're not going to make a firm decision on where until we see what the actual priorities get down in writing on and what we have to do. The other piece of it too is that this is going to allow the board to kind of talk about it amongst themselves and get buy-in. Hey Dave, what do you think the board should do? What do you think we should do on this one? Or what do you think we should do on that? We don't have to make a knee-jerk reaction at this point. We have a lot more time for that kind of informal dialogue and discussion surrounding it, and setting the direction, the tone, the path. It also allows us to explore vendors if any of those are needed. That by doing this up front and early, you can kind of say, hey, if we decide that we want to bank, your weapons manufacturers, and I'm not saying that we want to do that, but if we wanted to go down that path, can we find a consultant that we can partner with? And if we go down that path, help us build a program. And then we've taken the entry point from 6 to 9 months to 3 weeks because the consultant has a history of doing this and they already have the program built. We just have to implement it and tailor it to our specific bank. So I think the big piece is the communication, the education, kind of a revolving theme at the moment. But educate these people and let them know what is needed so that when it's time to act, they can act quicker with an educated decision.
All I will add is that I love what David said, because that is the definition of leadership, plain and simple. When you're the compliance officer, leading your subordinates, it's easy. It's fairly easy because your financial institution just told them, here's David. David is the compliance officer. He's the new boss. They have no other option. No other option. But what David was talking about here is actually providing leadership, strategic leadership to your peers in business, but also strategic leadership to your board of directors. And that's the name of the game, is that communication, is being an active leader. I'm not going to tell you what I think you want to hear, but I'm going to tell you what you need to hear so that you can make an informed decision, right? And that's what separates a manager from a leader. And as compliance officers, we don't want to be managers. Our responsibility goes beyond that. We need to be leaders. We need to inspire our peers in business, the front line. We need to inspire all of those, as well as the board of directors, by providing strategic intelligence. In government, we call that strategic intelligence or strategic information for them to make an informed decision. Because at the end of the day, that responsibility that the board delegates is their responsibility. My job as a leader is to provide that influential leadership going up, and David addressed that phenomenally well.
Yeah, and as well as having these conversations with, banking as a service, that you need to communicate with these fintechs, or, correspondent banking. This communication also needs to be had with them. Have you guys experienced that before? It doesn't necessarily have to be the the priorities, but anything before where you feel like, that communication, and make sure that they are also being educated, they're also being aware. How proactive has that been for you in the past?
Yeah, so I think I'm going to answer it in a different way, but I'll expand on it hopefully and get there. But I think one of the other keys is educate them before you jump in, especially at the board level, and make sure that the other piece I forgot in the prior piece, but make sure you're documenting it in your board minutes. That way you get credit for it. If it's not in the minutes, you don't get credit for and it doesn't have to be verbatim, but make sure it's documented so that you get enough credit that when the examiners come around, hey, we talked about banking as a service for 6 months consecutively, where I presented different risks, different avenues, and then we gave the green light, versus there's no evidence of that for 6 months. And, oh, we just decided we're going to do that. It's going to look completely different from an examination perspective if you have that in the minutes. And, you want to leave the breadcrumbs, for lack of better terms, that you're discussing this, you're having those conversations with the board. And it's a tough conversation with the board, but it's a heck of a lot easier than the conversation with the examiners if you didn't have the conversation with the board.
We say, and I've used this before many times, that we need to do everything we write. That means that we need to follow processes, policies, procedures. But to David's point, then we need to write everything we do. If it's not in writing, it doesn't exist. We need to memorialize our conversations. We need to document our conversations in a professional manner. Please, even those emails, when you hit send and I, Ray, the business guy for Bank 123, sends an email to David, the compliance officer, I'm creating a record. And I want to make sure that email comes professional. So we got to do everything we write. We have to write everything we do. That is the foundation of our compliance world, of our financial system, because there's a lot of turnover too. And if I come a year later to Bank 123 and there is a new compliance officer, David is not there, where's going to be my record of the actions, the briefings, the meeting, the minutes? So everything needs to be in writing.
Amazing. So last question, and then we'll see if we can open up to questions, see if anyone attending wants to ask you guys any questions as well. So looking ahead, right? There's still also a lot of uncertainty around CTR and SAR reform. So if that uncertainty continues, how can institutions adapt their risk assessment to stay agile? And if guidance remains vague, what should teams be documenting to show regulators they're making good faith efforts? One of the things you guys mentioned is to make sure that you have, that communication. But is there anything else that they should be, documenting as well?
Well, I'm gonna share with you a little bit of a story, actually two ways. And unfortunately, I'm going to go with my law enforcement hat. I know there's a lot of conversation and angst about CTR reform because the conversation is thresholds, thresholds, thresholds. The thresholds are low. Do I agree with that? Yes. But let me share with you a little bit of a story. As I'm retiring from government service, there was a criminal network operating in Washington, D.C. And what they were doing is they were shipping firearms that were used in murders in the Washington, D.C. area, specifically the Trinidad neighborhood, to the Caribbean. And the operation was financed with under $200,000. Most of the payments were under thresholds. Many people lost their life in the Washington, D.C. area and in some Caribbean islands to include St. Croix, St. Thomas, Trinidad and Tobago, Grenada, St. Lucia. When you look at 9/11, and a lot of what we do here, the way we do it is because of 9/11. The first attack to the towers was in 1993. The second attack was in 2001. Okay, that's 8 years later. 9/11 was financed completely with under $500,000. Of that $500,000, less than that moved through US accounts. If you divide that by the hijackers, if you take into account that some of them went to fly school in Florida, and you take some of that money, the payments were minimal. So again, I'm not advocating for the one or the other. I'm just saying that sometimes things are where they are, and there's a powerful reason behind those. That's all I'm saying, right? We will adjust. Um, we don't have to prove cases beyond reasonable doubt. That's not the standard for us. That's the standard for the government. We need to make sure that our onboarding is strong, that we're leveraging technology because we have to move fast in this environment. But we need to make sure, as David very well pointed out, that we have accurate information, that Ray is Ray and Ray is not Peter. We need to make sure that we have accurate, agile, fast information in this world. Otherwise, we're going to be losing clients. That is to say that at this point, continue to exercise your due diligence, continue to monitor based on the regulatory framework, and let's pay attention to what's going to happen in DC within the coming weeks, months, or years. There's a lot of things out there that in 2024 we're shaping. We're talking about risk assessment. We're talking about national priorities. But in June, July 2024, one or the other, the summer of 24, there was a notice of proposed rulemaking to build a sixth pillar of money laundering. And that is a mandatory risk assessment. We thought, oh, this is where things, and it's going to load all the national priorities. It is October, actually September, October tomorrow, September of 2025, and we're still waiting for that NPRM to come to fruition. So there's a lot of moving pieces. Don't worry about that noise. Concentrate in the legal framework you have established today. And trust me, as a former law enforcement officers, the law enforcement community, they go through your SARS. They look at those reports. Some of them, they come in the shape of a massive bulk report. Some others are user defined, but there is a lot more. I truly believe the law enforcement community, which they're doing some, I think they can do better. Or I can say, I think we can do better because once blue, always blue. But I think they need to share more information, and they should be able to tell you, David, that was a great SAR because of X, Y, or Z. Or, hey, the typology or the red flags that you identified, they were spot on. I think that feedback loop is necessary as we grow. But I'll be remiss if I don't say here that none of this will happen if we don't exercise phenomenal CIP controls at onboarding to make sure, as David mentioned, the data we have is accurate so that we can build a second to none data warehouse.
Yeah, I agree with everything, Ray. And I think, one thing I try to do, and I think that this is a good takeaway for any other BSA officers on the call, but if you get a SAR request, are you telling your team good job? Or are you just saying, hey, this is a SAR request type of thing? Like, you need to make this a big deal when you have a SAR that's hit on by law enforcement. Whether or not law enforcement's doing a good job at giving the positive feedback, you can own the stuff that you have control over. So make sure you're doing that for your teams. They appreciate hearing that. So a couple other commentary I have on this one. Risk assessment, like if the limit is or is not changed, document like a historical look on what this impact would be to your organization. If the limit's raised, how many SARs would you have not filed based on that new limit? And what would that have done to your SAR volume? What would that do to your CTR volume? You can kind of project historically, using historical data, you can kind of project forward on how that's going to, impact your future state. That's also going to give you a staffing component that could be a piece of this as well. But the biggest piece of this, using the historical data to project forward, if the limits are changed, is this going to be a really good education piece for your board that's going to tell them kind of the impact of the limits on your board. I mean, being very blunt, if the limits are changed, it's a simple change in any system to update it for the aggregation component. This is not hard, guys. If the limits change, you change it from 10,000 to whatever the new limit is, and the system's up to speed. The bigger piece, two items I've heard being floated around on the CTR and SAR changes for the aggregation component on CTRs is to make that a lot simpler and easier. That's where your real win is going to be, is if that changes and simplifies in some capacity. And then I've also heard that there's an individual and business threshold that they're potentially looking at lowering the individual threshold, but raising the threshold on businesses and changing some of the structuring components with that for SAR filing. I mean, how many people, yes, you know, the inflation component to CTRs nowadays, but how many individuals truly deal in cash with legitimate purpose? As Ray said earlier, it's a plastic society now, so there's a lot more credit card transactions than there were, when the SAR and CTR limits came out. So I think the other piece of all of this is, again, the educational components. If you haven't told your board or your senior management that they're talking about CTR limit changes, you're behind and you're late again. You don't have to tell them what the outcome is going to be, but just that it's being talked about is big. There's going to be a huge organizational component to it, because you're going to have to retrain your front end that's actually taking the cash for any CTR changes. The limit that's been instilled in them for how many years now? 40 years, 50 years of $10,000. That could be 40,000. That could be 5,000. That could be 75,000. We don't know where it's going to end up. We think it's going up, but we don't know until it's codified into regulation. The fact that there's changes coming, you should be mentioning this. It also gives them a little bit of hope that their job could potentially get a little bit easier. I mean, the tellers on the front end, they have probably one of the most difficult jobs in the bank with all the regulation they have to know. Not only do they have to know all the BSA AML regulation, they have to know all your other compliance regs, your Reg E, your Reg B, your Reg GG, etc., Reg CC for holds and such. They have a lot more regulation knowledge than you do in the BSA space. You just have to know the BSA space a lot more. So I think the big piece is the agile piece is we don't know what the end result is going to be. We know there's going to be change in some capacity. We just don't know how it looks. They're looking at also changing the SARs and CTR, the actual forms. So that changes some things as well. And, how many of the national priorities aren't explicitly listed on the SAR form at this point? That's got a potential just to be another checkbox. That's pretty easy. But if they change the actual way that a SAR form is completed, filed, aggregated, that could change a lot more with the program. So the industry hope is that we do the right thing and we get the forms where they need to be. But the industry hope is this isn't something that I'm going to have to rewrite and rebuild a complete suspicious activity monitoring program to address the priorities. That it's just hey, we're already doing this, check this box on the form when you fill it type of thing, versus there's a whole new SAR form coming out, which I don't know that's happening, but I don't know that it's not happening either. So we'll see kind of where that lands.
Awesome.
Well, let me mention that if someone wants to read a little bit on national priorities, what they are, basic definitions at the very basic level, and with some red flags. I actually wrote about 10 articles for ACAMS Today. They were all published. Some they should be all online on each and every one of those priorities with red flags. And again, I mean, there's nothing new about those, right? But at least a definition through a law enforcement lens at a practical level without quoting legal, sometimes complicated lingo. So if anyone wants to read on those and break things down, and there's also I hyperlink a lot of information to some of the white papers that or the guiding papers that FinCEN provided. They're there. I just dropped my email to the chat. If you don't have access to ACAMS Today, I have those in PDF format. I'll be more than happy to share those with you.
Thanks so much, Ray. This has been a very insightful discussion. What really stands out is that even without full regulatory guidance, institutions should not be standing still. They should be documenting their approach, adjusting risk assessments as much as they can, and KYC programs where it makes sense, and obviously keeping that flexibility at the core of the strategy. David, Ray, thank you so much for being here with us, for sharing your perspective, and thank you to everyone that joined us today. We really hope that this conversation helps you think strategically about risk assessments in the space, your KYC, and an AML compliance in a very practical and agile way. Until clear guidance arrives, staying flexible, documenting decisions, and keeping your teams, boards, and partners informed will be key for this specific topic. Thank you again, everyone, and we look forward to continuing dialogue in the future. I hope you all have a great Tuesday and an amazing week. Bye.